Good afternoon. Welcome back. We are going to stream the FOMC rates event. Welcome, Taurus. King Arthur, welcome. All right. Fed decision is in 5 minutes. I'm trying to put everything together here. I'm gonna get the summary of economic projections, the last one. So that let me lower the volume here. So I got the news. I'm gonna put the news right at 2, so we can go ahead and comment. All right. In the meantime, I'm gonna download the summary of economic projections for the September meeting. All right, so I have it here. Let's download it. There we go. FOMC SAP September 2022. There we go. So I don't lose it again. Nice. All right, I have it here. And so I think we can put this. All right. There we go.
Fixed income portfolio manager at Morgan Stanley.
So you guys hear the news, right?
I think we got, if this was a roulette reel or a
let me know about the volume.
You all think it's going to be 3/4 of a point, right?
Yep.
Yes,
That's correct.
Acknowledge the
That's
nods.
right.
Let's see the nods one more time. Everyone nod.
Raise your hand.
So what would the language, Jim, Karen, be like if they were trying to?
All right, let me search up here the CME
than a war on
rate hike
inflation.
probability.
What would the language feel like?
A couple minutes before.
Well, I think this is the key. It's going to be what they say, not what they do. 75 basis points is baked into the cake. I think
It's 95%. So 3/4% is what we're expecting.
Very narrow needle. And what would be indicative of something?
So the markets were going down, now are holding right here around the overnight low.
Saying that, we may be thinking about the pace of rate hikes starting to slow or things like that. But more likely, what he's going to do is he's just going to.
If you like the video, I would appreciate it. Hit that like button
Understand that we need to see the inflation
and share so we can get to more people.
Actually starts to act. So that's more likely what he's going to say. He has to be hawkish in terms of what he's saying in order to make sure
hit that like button.
Message that he's going to remain vigilant in fighting inflation.
I mean, the data dependent.
Thank you,
part of it is
person.
really
Thank you.
tricky, right, David? Because I mean, just in the last 2 days, we had jobs,
All right.
higher than expected job openings. This morning,
Thanks, buddy.
ADP, which is greater than expected number of private sector jobs last month. So we're still seeing a lot of strength and resiliency in labor, which then in turn potentially translates to ongoing strength.
Slowly, buddy.
As well, right?
All right. Based on the summary of economic projection, we can talk about later. Like we will have time from 2 in the afternoon to 2:30 to comment about the report that came out in September and what is going to happen in the future, or what the Fed expect the economy will do in the future. So what do you think about the volume, though? Do you hear the news?
It's just a very bad idea for monetary policy. You've got to be forward-looking. If you wait until inflation falls, you'll have waited too long to stave off recession. I mean, what we are seeing here is some better news on growth. I think growth will stay positive in the fourth quarter, but we are seeing positive news in inflation. And I think the Fed will have to acknowledge that in their statement, that there's better news in inflation. The key question is whether we're going to get some indication that there'll be fewer hikes, or there may be some more hikes rather than just ongoing monetary tightening. That's really the question. It's all about the messaging, as Jim said.
Mona, what would those signals sound like to you?
All right,
That perhaps
20
the
seconds. The
phase
spread is
would be a
already.
little easier on it.
I think the spread
Yeah,
is
you know, I
already.
think Jerome Powell will be clear.
I don't know.
If he
Spread
does
is fine.
indicate that perhaps the next meeting or two will be a less, you know, aggressive rate of
I don't know if this thing is.
increases, maybe lower than the 75 basis points they've done.
They're just talking shit, and the thing is gonna come out. There we go. All right, so this thing went up. Oh my god. The hell happened here? So you got Biden talking.
Berating big oil and charging more for their profits. That's not going to drill more oil, and it certainly won't help us. We'll explain.
What the
because
fuck is this?
The second biggest issue in a market. And at 2:15, I've got Market Rebellion co-founder John Najarian. He's going to break down how you ride out not only the green trade, but all of volatility in the market. Now to Edward Lawrence.
There we go.
The Federal Reserve is raising
Let's get to
75
Caleb
basis
Townsend now with
points.
the Fed.
75 basis point, guys. 75 basis point.
The statement added this line saying the Fed anticipates ongoing rate increases will be appropriate to get inflation back to the 2% goal, and then
75 basis
says
point.
this, quote, in determining the pace
The market
of
is
future
taking it
increases in the target range,
pretty
the
good.
committee will take into
Dollar is
account the
tanking.
cumulative tightening
Dollar
of monetary
is
policy, the
tanking.
lags which monetary policy affects
Wow.
the economy and economic activity, and inflation in economic and financial development. So the Federal Reserve
Look at
statement
that.
says that they're going to see modest growth. They have
Damn.
seen that in the economy, in spending and production. Job gains, it says, has been robust. The Fed
Dollar's
says that
tanking,
inflation is
guys.
elevated, saying it's
NQ
elevated
is up
of supply and
0.5%.
imbalances, mainly due to the pandemic with food and energy prices. The statement says the war in Ukraine is putting that upward pressure on inflation again, and the Fed indicates that they want to continue the rate of balance sheet runoff on that predetermined path that they had laid out. Now, this decision was unanimous. So again, the big takeaway from this, in addition to the 75 basis point hike, which we expected, is that they are saying here that determining the pace of future increases, they will take into account the lag effect that happens with monetary policy, as well as the cumulative tightening that they're doing. So the interest rates, as well as the balance sheet runoff.
So they come a lot dovish,
slowdown
guys.
in the pace, or possibly a pause. They're leaving the door open here.
They come a lot more dovish, though.
Policeman Bob Pisani and Rick Santelli to the conversation. Steve, let's start with you and that change in language that Kayla just laid out.
Yeah.
Yeah, Kayla certainly highlighted the most important part right there. And it looks like there's two pieces to it. The first one here, in determining the pace of future increases in the target range, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity, inflation, and economic developments. So the first part, the part I didn't read, is they want to make sure...
Now, probably Fox just restrict the image, so I'll stick to CNBC.
Slower here. I don't think I would mistake this for saying the Fed is ready to pause. I think it's
yes.
something you might digest and say the Fed is aware that it's done an awful lot and doesn't feel it has to do.
Yes, MB. They need to just pause a little bit and then let this thing works.
Come down a little bit. We'll see if that holds. But that May contract was trading at 503 for a high, for a peak funds rate. Now it's at 496. So not much of a
hard landing in February. There's no way we have a soft landing. It's hard.
The statement came out as believing the Fed has still considerable work that it will be doing. So maybe a slower pace.
It's hard for them to achieve the soft landing.
Yeah. And yet it seems to be a slightly different story where equities are concerned right now. Bob,
all right, look at the Yankee. Look at the ES. Right at the supply. Now they came a lot more dovish.
Moving higher, markedly higher as well. I mean, when you look at the equity markets, was it just spring-loaded for any teeny tiny sign, any little bit of hope that anything could be even the slightest bit more dovish than what we have seen previously?
Oh,
yeah.
This is more dovish than I think most people were expecting. Yeah. I mean, when I called and said, is the Fed going to indicate any kind of pivot, any hint of anything? Not in a statement, maybe in the press release. That was the consensus. But look here, all right, Steve's right. This is not a pivot, but the committee will take into account the cumulative tightening of monetary policy. Hey, that's good enough for the bulls that are out there. Look,
Yeah, I won't be trading till 3 p.m.
The S&P 500, 300 points in the Dow easily on that, and that's close enough. Now, on the press release,
Did you get it, Taurus?
Excuse me. Maybe he'll talk, more clearly coded words. He'll say two-sided risks or risks of slowing growth, something like that. But this is a fairly nice bone to throw to the bulls right now. I think the problem right now for the market is the job market's not cooperating. These JOLTS report, the ADP stronger, and people are afraid the Friday jobs report is going to be a lot stronger.
Wow, the dollar tanked.
Look how far we've come here, guys.
Dollar went down big time.
S&P 500, we were at 35.50 just a couple of weeks ago. Dollar's a little bit lower. Two-year yields have flattened out a little bit, so it's understandable why the market has rallied. But this has really been very, very impressive right now. The problem for the market now is what else are they going to really say to get the market notably higher? We're already trading nearly 17 times forward earnings with no change in the earnings estimates of about $230 for next year. This is a lot of expectations already into the market. But right now, this is about as much of a bone you're going to throw to the bulls as anyone would expect, guys.
Rick Santelli, do you see it the same way? What is the bond market telling you about
Nice.
this language in the Fed statement?
Well, I'll tell you what, we knew it was going to either be a pause, pivot, or continue to punish, the 3 Ps. But I think they weaseled in a little bit and threw the markets a small bone. Granted, it's maybe the size of a wishbone, but I'm wrong. I didn't think they'd throw any bone. The wording as it was put forth and what I heard from Kayla and Steve, to me, sounds like they gave it a little wiggle room, which explains stocks, and the markets smelled it right. I'm always a big believer in market whispering. And if you look at a 2-year yield, it started to creep down. If you looked at the euro and the dollar index, the euro, well, it started to creep up. The dollar index started to creep down. Those are both very telltale signs that we're going to be a little less hawkish than maybe many anticipated. And I think when it comes to what the Fed's going to do,
Nice, Taurus.
anybody who discusses
He comes out at 2:30. He will read the statement and then the Q&A.
They are looking at a spot down the road, and they change what that area may be. But truly data dependent.
It's 2:30 MB. So the market is going up right now, but he could tank it later. So, but I think that's a dovish message that they want to throw up.
Fed fund futures, which the moves are small, or the moves in the current Treasury complex where yields are moving down. It's certainly a different response to this meeting than the last several three-quarter point increases.
Mona, I want to bring you back into this conversation, get your reaction to this, not only this increase, but this change in language. In determining the pace of future increases in the target range, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity, and inflation and economic financial developments. I know we've already heard that read, but just to say it again, because it goes back to that conversation and the point that Rick just brought up about data dependency and the fact that now you're starting to see the Fed look at this and approach this maybe in a slightly different way than we've seen it in the past, at least in terms of this statement. What does it mean? What do you think it tees us up for with that press conference in just?
I don't think the market will close positive this year.
It's interesting.
It's going to be hard.
Brought up two important points that we really haven't addressed or
Probably 10% up from here, but positive for the year is going to be hard.
If you acknowledge they started near the zero bound.
We have too much headwinds.
4% on the Fed funds rate, or close to 4%. So they've already tightened this year cumulatively close to 400 basis points. In a given year, that is pretty unprecedented. And the second part of the statement that I think, again, perhaps a nod to the bulls, or at least those that are rooting for a slower pace of rate hikes, they're acknowledging the lag impact. You know, in reality, or the Fed funds rate, there is about 2 to 4
10% from here.
lag, from when the Fed tightens to when we see it hit the real economy. Now, some parts of the market and economy are very interest rate sensitive, and we are seeing
it does,
housing, for
Pearson.
example,
Economy moves very slow.
Already showing signs of softening, weakening, perhaps even rolling over. Rental prices, which, you know, as we all know, shelter and rent components of CPI have been sticky, but the underlying fundamentals are telling us a different story. So it is interesting to hear certainly the Fed talk about in its statement.
So we did have this
it's tightened quite a bit already, that there is a lag impact. Perhaps
This is the man right here.
Hear from Jerome Powell is
Let's
they
put
want
it
to
on
wait and see and assess
15 minutes.
what that lag
There we
impact
go.
looks like. Do we see a softer labor economy? Do we see wage gains start to moderate a little bit? And do we see inflation rolling over in a more meaningful way? I think that's probably, even whether they acknowledge it or not, that's probably what they want to wait and see.
Well, I did have this, and I did have this on the NQ as well.
In a more holistic way. And certainly they're thinking
These are zone Tesla supply. Do you see that? The one that I put in the morning.
It sort of strikes right at the question that
Certainly
everyone's been
stopped the
asking
price
ahead of
right
this
there.
decision, which is under what conditions would a step down to 50 basis points be appropriate? It's worth noting that the September dot plots, they actually indicated a
This was my short yesterday that I did not take,
this meeting today, and a step down to
and
50,
it's
actually
working
did that in the
right
last
now.
2 meetings. So how much has actually really changed here, potentially?
So I think a lot has changed. I actually think this is pretty huge. One of the things that the Fed said is that they want to get to levels that are sufficiently above neutral. What they're communicating right now, and I think this is the big news here, is that they want to get to a point where they just stop hiking interest rates. In other words, there are many forecasters out there that would have Fed funds forecasts going up to 5, 5.5, 6, and beyond in order to get inflation down.
No, that ain't gonna happen.
Is that they're willing to get to a level that's sufficiently above neutral and keep rates there, and then wait for inflation to start to come down. So what that really signals today to me is that this is the start of the end game, meaning that, yes, the next move in December might be 50 basis points, and we might get another 50 and then a 25, and maybe they end at 5% terminal Fed funds rate. But then they stop at that level for a period of time, and they wait for inflation to come down, because sufficiently above neutral is the key. How much of a policy rate is considered to be sufficiently above neutral? Is it a 5% policy rate? The neutral Fed funds rate is 2.5%. So at 5%, you're 250 basis points above neutral. That might be sufficient. And from a cost-benefit perspective, it doesn't do as much damage to the asset markets and to the broader economy by just, in mortgage market, housing, and things like that, by just hiking rates and hiking rates and hiking rates in order to achieve your inflation goal. What they want to do is let these high rates marinate. As Mona was saying, these long and variable lags are going to come into effect, and that the necessity to continue to hike rates is not necessarily there once they get to their terminal, which I think is 5%. And I think that's the message that the market's seeing right now, and it's one of the reasons why it's bullish. I'd be bullish on this too.
David, do you see it as Jim does? Do you see it as the market does? Is this the first move of the Fed to prepare the public and the markets for the moment? I'm thinking in terms of a big 18-wheeler, the air brakes are releasing some of the air.
Yes, and I think this is very significant, because they've gone from data dependence to forecast dependence, which of course is what
There is a
they've done all
potential
along.
long here
And the reason this
also.
is so significant is that if
Well,
you look at
for
leading
any
indicators of
long,
inflation, things like the global vendor delivery index, it's almost back to normal levels. There are no ships.
for any longs in this move up, I will have to go to the share bars. Let me see what the share bar tells me.
All of these things suggest that inflation is on a downward track, and if the Fed just let that happen and is willing to be forward-looking about that, that means they don't have to get as high.
Probably this one
For the bond market, it's a big positive for the equity market, and markets
right here.
are correct and reacting so positively to
But it's not the best one. I certainly will not take it. Okay.
Somebody who watches the Fed and
321.
so closely, the significance from your standpoint, and well, yeah, let's start there.
Starting here.
I'm having a hard time seeing much change here. I mean, it is true that the Fed did put in to the statement that which I believe the market had already precisely priced already. I'm not seeing a big change, for example, in the odds for a 50 or 75 basis point hike in December.
All right,
it's
let me
60-40. We went in.
I'm gonna lower this volume, and I want to check this with you guys. This is a summary of economic projections. For those who don't know, this report comes out 4 times a year, and we have 8 meetings. So every 2 meetings is that they put this summary of economic projections out. Okay, so here We have to work with this one till the December one.
Than it was previously, but all of that is dependent upon the data cooperating and inflation. If inflation does come down, yeah, then I can start to spin a more
so where we are right now is here.
a tougher one. So I think the Fed has an appointment with.
What time is it? 2:14. So we still have time till Powell comes out.
4.5 to 5, that is, in the spring in their calendars.
All right, there you go.
Much about this statement changes that. They are going to be what they say to get to be sufficiently.
All right, so we are right now at 4, right? And they want to end up the year at 4.4. So there is 4.4 and the range is 4.1, 4.4. So the central tendency and the range is 3.9 to 4.6. So we most likely have 50 basis point next meeting. Okay. So we do have projection for the PCE 5.4. And what was the last that we got? Let's go check PCE. That was last week.
Very interesting. Jim, let me come back to you, if I might, and ask you,
PCE.
do you see it as Steve does, which is to say that perhaps the Fed is going to reach its terminal point sometime in the spring?
Core PCE.
I do. I do think what Steve said is correct. What's been priced in the market
PCE inflation, June projections.
terminal rate of 5%, and I think that's
Sorry, June projection and this into September.
As Steve also pointed out, is that they put it in the statement. So I think what that does for us is in the markets in terms of thinking about the probability of outcomes.
Core PCE, PCE prices.
That probability distribution tail, that is, that rates go materially higher than that. Whereas before this statement
In
was
the
made, somebody could have said, hey, they might have to go to 5.5% in order to bring the unemployment rate up.
So PCE inflation year over year is 5.1. We are within their expectations, so they might slow down depending on the PCE of November. So we will have one more PCE before the next meeting. And if this number is below 5.4, like it is right now, for September was 5.1. I think we will have probably, instead of 50 basis point, lower than 50 basis point.
Right now on the heels of this statement and the change to language. Any reason to believe, just based on recent history, going back to Jackson Hole, that Chair Powell is not
GDP, yeah, here
I can't imagine that Fed officials
they're expecting 0.2%, basically flat GDP for the rest of the year. Not for the rest of the year, for the 2022. And the range is from 0 to 0.5% growth.
Starting to see a bit of that. Powell and team would come back and really walk back the market and try to take that.
All right, let me get ready for the press conference.
The statement today.
I'm gonna get to the Treasury. Sorry, to the Fed website.
That talks to or speaks to a Fed that may be thinking about, as we've all said, moving at a more moderate pace. Doesn't certainly imply a Fed pause. But to Jim's point, as you think about heading towards a peak in the Fed funds rate, and perhaps now we can start thinking about modeling that in a more, realistic manner. When you do look historically through Fed cycles, when we are, at the point of that terminal rate hike, the 12 months after that, in particular for equity markets, are quite strong. And historically, and of course, every cycle is unique, but on average, the 12 months after the Fed peak is up about 16% on the S&P. Notably, the bond market also, of course, acts very well when we're headed towards a peak, not only in Fed funds rate, but a peak in that 10-year Treasury yield. And we may be, getting that as well alongside or maybe even ahead of a peak in.
So they do have a more dovish, and that was one thing that I was actually thinking about, and I don't know if we talked about that in the morning. Like how more hawkish can they be? And at this point, I think there's no way they can be more hawkish. Like, could they like reduce their balance sheet in a faster pace? Yeah, probably, but that would really damage the economy, and it won't bring inflation down immediately, right? There's no magic pill for inflation. We need time to pass, so we get some contraction in the economy, and hence inflation comes down, right? So they probably fear that what they're doing is too much because of this speech. Let's see how he comes. If he comes a lot more dovish.
Right, right. So here's the key point. Everything you said is right, but why is the market reacting so well to this? And, you know, my old motto on this is don't yell at the stock market. Don't say the stock market doesn't understand something here. Look why it's going up and try to understand why it's rallying. And the reason it's rallying is there has been a fear for a long time that the Fed is going to be far more aggressive than the market anticipated. That was sort of built in. And what it's saying here is we're a little relieved by what we're seeing here. We're less fearful. So the logical question for Powell, the first question is, so Mr. Powell, does this lag with which monetary policy affects economic activity inflation that you cite in your press release, does this mean forget 75 basis points, it's not happening, 50 basis points is likely? And how much time do you need to let high rates marinate? Jim used the word marinate. I love that word. It's terrific. Before you essentially decide to start going in the other direction. They've opened the door to that question right here, and that's why the market is rallying. Much less anxiety about the Fed outpacing everybody else and essentially raising much faster than anybody had anticipated.
All right, Bob, and our panelists, David Kelly, Mona Mahajan, Jim Caron, as well as Steve and Rick. Thank you both. Thank you all very much. Let's bring in now former Federal Reserve Board Governor Frederick Mishkin. He's also a CNBC contributor. He's a professor. He's a lot of things. Frederick Mishkin, welcome. In my notes, it says, given this, you say, it is premature for there to be any talk of slowing the pace of rate hikes because that will weaken the Fed's credibility that it will do what is necessary to contain inflation. You've listened to a lot of discussion here. You have read and seen what the Fed has said. Have they fallen into the trap that you outlined in your note?
Not yet, but I do worry that that it's premature to talk about slowing down increases in interest rates. Realize that we're still at very low interest rates relative to inflation, and that's the key. That in order to deal, and also that
relative to inflation, yes, but relative to expected inflation, we're not very far.
In terms of really turning 180 degrees, they made huge, I think, very major mistakes, which I'd been talking about for almost a year and a half, but they now have got their act together. The problem here is that when you look historically and you look at cases where inflation gets out of control, the central bank or the Federal Reserve gets behind the curve, you've got to raise rates, and these are real interest rates, the interest rates adjusted for inflation, to levels which are at least 2-3%, and sometimes you have to even hit the economy much harder with the baseball bat, which is what Volcker had to do. So we're in a situation where any projections of what we think inflation will be over the next couple of years is certainly above 3%. Maybe we'll get lucky. And so this is telling us that the Fed needs to get at least to 5%, and I think even higher than that. And indeed, because they got behind the curve, they've got to show that they're really serious about getting inflation under control. And if they don't do it, they'll have to raise rates by even more, which would make things even worse.
So let me go back to what my notes say you said to us, and that is that it would be wrong to do any, quote, talk of slowing the pace of interest rate rises. And it seems like you're saying they didn't say that. They didn't fall into that trap.
No.
So what is it that they did say in saying we are cognizant of the fact that there are cumulative effects of what we've already done, and that there will be lagging effects from what we will be doing?
So this is actually what you should always do. Okay, so the monetary policy has long lags. I do worry a little bit that there are some more voices, and you sometimes hear them from the Fed, about some concerns about whether they could go too far. I just think that it's premature to do that now. That should they worry about this? Absolutely, they should. But we've seen absolutely no evidence that inflation is particularly inflation, which is taking out some of these volatile elements like food and energy, is contained and is moving back to 2%. No evidence of that. And the Fed did get behind the curve. They've got to correct for that. I think actually they're very striking and extraordinary moves. These are the largest meeting rate increases that we've seen since the Fed started targeting the federal funds rate. So there were larger increases during the Volcker era, but that was not a period where the Fed actually said it had a target for the federal funds rate. So that's extraordinary, but they have to keep on doing it to basically make sure that people realize that no matter what, they're not going to let inflation get spin out of control. Because if they do, they'll have the mistake that Volcker made in 1980 when the Fed backed off. And the markets then it took a lot more. They had to really kill the markets. They backed off, they lowered interest rates, and then they had to raise them another 1,000 bips, another 10 percentage points in order to get where they were. And that really killed the economy. So that was the worst recession in the post-war era. I don't think we're going to be there. I think the Fed is cognizant of this, but mistakes could be made. And I have to be honest, I actually think I'd rather have the mistake right now be made that the economy ends up a little softer than otherwise, rather than easing up and then really having to clobber the economy later. So, it's a balance of risks. It's not an easy business to do this. The Fed has made some mistakes and has got some very bad breaks. The Ukraine war is a nightmare for deciding on what to do policy-wise. It's a bad shock. And of course, it's a disaster for the Ukrainians. So it's a tough position, but I think that which way they have to lean, and particularly in their rhetoric, is to indicate to people that they're not going to make the mistake of easing up too quickly, as has been done in the past.
Yeah, as a millennial, I'm still wrapping my head around 1,000 basis points. But because we haven't seen that really in my lifetime. That being said,
those were wild times. I had a mortgage at one point during that period, and boy, they had mortgage rates which were close to 20%. It was just
it doesn't make sense for me that they will back off.
So given all the points
Like how they will just turn around. They will U-turn like suddenly.
Very robust.
It doesn't make sense. Especially
that the Fed watches most closely from an inflation standpoint.
Inflation hasn't come down yet.
Sticky here. What would you expect from Chair Powell when he takes the podium in 4 minutes, given the fact that in many ways this has been, Richard Fisher said it this morning on our air, this has been the most transparent Fed historically we've seen, given the fact that he does do all of these pressers after all of these meetings?
Well, I don't know if I completely agree with that. The Fed started these press conferences a while ago, and I think that they are a big plus in terms of transparency. I've actually faulted Jay
you're right.
for not being transparent enough. I think that this was a big problem with the way they did average inflation targeting. It was not done transparently, and as a result, actually weakened the what looked like the commitment of the Fed to the 2% inflation goal. So I would take.
Now, here's my opinion, and only my opinion. This is very personal. I do think they will probably slow down, and would probably even cut interest rates next year. Not aggressively, but they will have put so much damage into the markets that market will continue to drop until they actually stimulate the economy again. That's my theory. Like the U-turn is not only rates cut, but stimulating the economy. That was what brought the markets off of the woods in the dot-com bubble and the 2008-9 real estate crisis. Right now, I think they will break something. We don't know yet.
Morgan, mild relief. I think the market probably has it correct that this was not in the statement any kind of a real game changer, not a statement of intent to go a lot easier, but definitely a signal of emerging potential flexibility in how the Fed goes. Wouldn't be surprising to see Chair Powell essentially point us to the fact that this new statement is pretty consistent with the September FOMC consensus outlook for where the Fed funds rate would end up next year, averaging 4.4. So this, slowing the pace a little bit seems like it's not that big a break from where we were about, 6 or so weeks ago. That's probably number one. I do think that it shows you that the Fed is not at this point, as a sense of urgency or dogmatism about exactly where rates have to go. But as Steve was saying, as everybody's been saying, anything that they do in the way of slowing down is premised upon inflation cooperating, and we have yet to see that. So in that sense, we're data dependent, even if they're not saying we are data dependent.
So, yeah, it does feel that way. It feels like they're saying we recognize, acknowledge the need to watch and see what the effects of our moves have been, which is then just one sort of half step away from saying we're cognizant of the idea of the fact that we may have to take our foot off the brake a little bit at some point before we get to that point of 2% inflation.
Yeah. That's right. And look, we know what's going on with housing. We know they've described their campaign as front-loading the tightening process. And if they're front-loading it, then getting to 4% in 7 months or 8 months seems like that's a pretty good job of front-loading. So all that stuff is pretty consistent with where they've been for a while. I think we got used to a Fed that was sometimes looking for a plausible excuse to go easier. That's not this Fed. They can't operate that way. They can't afford to when, you know, inflation's running at 3 to 4 times their target.
All righty. Well, let's keep talking here a little bit while we wait for Chair Powell, who is probably going to come out here in just a couple of seconds because we are at 2:30 p.m. and he is typically runs very.
So let me put the Federal Reserve website. Yeah, there you go. I don't listen here. All right, he's out.
Good afternoon.
There you go.
My colleagues and I are strongly committed to bringing inflation. We have both the tools that we need and the resolve it will take to restore the Federal Reserve and serves as the bedrock of our economy. The economy does not work for anyone. In particular, without price stability, we will not achieve
All right, I'm having troubles here.
In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. The FOMC raised our policy interest rate by 75 basis points, and we can. The FOMC raised our policy interest rate by 75 basis points, and we can. Increases will be appropriate. We are moving our that will be inflation to.
I don't know what's going on with my computer, guys. Or is there a website?
Stance of policy for some time.
Yeah, my internet is very slow.
Maintaining a restrictive stance of policy for some time. Reviewing economic development.
I think it's their website.
More to say about today's monetary policy actions after brief. It has slowed significantly. Page rose. It has slowed significantly. Page rose. Indicators point to modest action.
Okay, this is not working.
But is unchanged so far.
This is not working.
But is unchanged so far this year. Recent indicators point to modest growth of spending and production this quarter. Growth in consumer spending has slowed from last year's rapid pace, in part reflecting lower real disposable income and tighter financial conditions. Activity in the housing sector has weakened significantly, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. Despite the slowdown in growth, the labor market remains extremely tight, with the unemployment rate at a 50-year low, job vacancies still very high, and wage growth elevated. Job gains have been robust, with employment rising by an average of 289,000 jobs per month over August and September. Although job vacancies have moved below their highs and the pace of job gains has slowed from earlier in the year, the labor market continues to be out of balance, with demand substantially exceeding the supply of available workers. The labor force participation rate is little changed since the beginning of the year. Inflation remains well above our longer-run goal of 2%. Over the 12 months ending in September, total PCE prices rose 6.2%, excluding the volatile food and energy categories. Core PCE prices rose 5.1%. And the recent inflation data again have come in higher than expected. Price pressures remain evident across a broad range of goods and services, Russia's war against Ukraine has boosted prices for energy and food and has created
boogeyman.
additional upward pressure on inflation. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. But that is not grounds for complacency. The longer the current bout of high inflation continues, the greater the chance that expectations of higher inflation will become entrenched. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we're strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by 75 basis points. And we are continuing the process of significantly reducing the size of our balance sheet, which plays an important role in firming the stance of monetary policy. With today's action, we've raised interest rates by 3.75 percentage points this year. We anticipate that ongoing increases in the target range for the federal funds rate will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. Financial conditions have tightened significantly in response to our policy actions, and we are seeing the effects on demand in the most interest rate sensitive sectors of the economy, such as housing. It will take time, however, for the full effects of monetary restraint to be realized, especially on inflation. That's why we say in our statement that in determining the pace of future increases in the target range, we will take into account the cumulative tightening of monetary policy and the lags with which monetary policy affects economic activity and inflation.
Look at the markets, guys.
At some point, as I've said in the last two press conferences, it will become appropriate to slow the pace of increases as we approach the level of interest rates that will be sufficiently restrictive to bring inflation down to our 2% goal. There is significant uncertainty around that level of interest rates. Even so, we still have some ways to go, and incoming data since our last meeting suggests that the ultimate level of interest rates will be higher than previously expected. Our decisions will depend on the totality of incoming data and their implications for the outlook for economic activity and inflation. We will continue to make our decisions meeting by meeting and communicate our thinking as clearly as possible.
Wow.
We're taking forceful
steps the dollar is reacting off of the demand
right there. Supply. Our overarching focus is using our tools to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Reducing inflation is likely to require a sustained period of below-trend growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices in the longer run. The historical record cautions strongly against prematurely loosening policy. We will stay the course until the job is done. To conclude,
there you go.
We understand
he put
that
the
our
mask of a hawk again.
Families and businesses across the country.
It was
everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Thank you, Colby.
Yeah. Oh my God.
Thank you. Colby Smith with the Financial Times. On the need to slow the pace of rate increases at some point, is a downshift contingent on a string of better inflation data specifically between now and, let's say, the December meeting? Or is that something that the Fed could potentially proceed with independent of that data, given the lag effects that you mentioned?
So a couple things on that. We do need to see inflation coming down decisively, and good evidence of that would be a series of down monthly readings. Of course, that's what we'd all love to see, but I've never thought of that as the appropriate test for slowing the pace of increases or for identifying the appropriately restrictive level that we're aiming for. We need to bring our policy stance down to a level that's sufficiently restrictive to bring inflation down to our 2% objective over the medium term. How will we know that we've reached that level? Well, we'll take into account the full range of analysis and data that bear on that question, guided by our assessment of how much financial conditions have tightened, the effects that tightening is actually having on the real economy and on inflation, taking into consideration lags, as I mentioned. We will be looking at real rates, for example, all across the yield curve and all other financial conditions, and as we make that assessment.
Hi, Howard Schneider with Reuters. Look, I'm sure there's going to be tons of confusion out there about whether this means you're going to slow in December or not. Would you say that the bias right now is not for another 75 basis point increase?
So what I want to do is put that question of pace in the context of our broader tightening program, if I may, and hit to talk about the statement language along the way. So I think you can think about our tightening program as really addressing three questions. The first of which was, and has been, how fast to go. The second is how high to raise our policy rate. And the third will be eventually how long to remain at a restrictive level. So on the first question, how fast to tighten policy, it's been very important that we move expeditiously, and we have clearly done so. We've moved 3.75% since March, admittedly from a base of 0. It's a historically fast pace, and that's certainly appropriate, given the persistence and strength in inflation and the low level from which we started. So now we come to the second question, which is how high to raise our policy rate, and we're saying that we'd raise that rate to a level that's sufficiently restrictive to bring inflation to our 2% target over time, and we put that into our post-meeting statement. Because that really does become the important question, we think now, is how far to go, and I'll talk more about that. We think there's some ground to cover but before we meet that test, and that's why we say that ongoing rate increases will be appropriate. And as I mentioned, incoming data between the meetings, both the strong labor market report, but particularly the CPI report, do suggest to me that we may ultimately move to higher levels than we thought at the time of the September meeting. That level is very uncertain, though, and I would say, we're going to find it over time. Of course, with the lags between policy and economic activity, there's a lot of uncertainty. So we note that in determining the pace of future increases, we'll take into account the cumulative tightening of monetary policy as well as the lags with which monetary policy affects economic activity and inflation. So I would say as we come closer to that level, move more into restrictive territory, the question of speed becomes less important than the second and third questions.
Yeah, you're already there.
I've said at the last two press conferences that at some point it will become appropriate to slow the pace of increases. So that time is coming, and it may come as soon as the next meeting or the one after that. No decision has been made. It is likely we'll have a discussion about this at the next meeting, a discussion. To be clear, let me say again, the question of when to moderate the pace of increases is now much less important than the question of how high to raise rates and how long to keep monetary policy restricted, which really will be our principal focus.
If I could follow up on that, to what degree was there an importance or weight given to a need to signal this possibility now, given all the concerns really around the globe about Fed policy sort of driving ahead and everybody else, dealing with their own stress as a result?
Well, I think I'm pleased that we have moved as fast as we have. I don't think we've over-tightened. I think there's very difficult to make a case that our current level is too tight, given that inflation still runs well above the federal funds rate. So I think that at this meeting, the last two meetings, as I've mentioned, I've said that there would come a point, and this was a meeting at which we had a discussion about what that might mean, and we did discuss this, and as I mentioned, we'll discuss it again in December. But there's I don't have any sense that we've over-tightened or moved too fast. I think it's been good and a successful program. That we've gotten this far this fast. Remember, though, that we still think there's a need for ongoing rate increases, and we have some ground left to cover here, and cover it we will.
Nick.
Nick Tamarosa, The Wall Street Journal. Chair Powell, core PCE inflation on a 3 or 6 month annualized basis and on a 12-month basis has been running in the high 4s, close to 5%. Is there any reason to think you won't have to raise rates at least above that level to be confident that you are imparting enough restraint to bring inflation down?
Inflation expectations, guys.
So
that's what I think.
This is the question of does the policy rate need to get above the inflation rate? And I would say there are a range of views on that. That's the classic Taylor principle view. But I would think you'd look more at a forward, a forward-looking measure of inflation to look at that. But I think the answer is we'll want to get the
I think this is going to be the range.
Where the real interest
let's see
rate is positive.
if
We will want to do that. I do
one
not
question
think of it
just
as
move
the
this thing out of the
single
range.
touchdown, though. I think you put some weight on that. You also put some weight on rates across the curve. Very few people borrow at the short end of at the federal funds rate, for example. So households and businesses, if they're very meaningfully positive interest rates all across the curve for them, credit spreads are larger, so borrowing rates are significantly higher. And I think financial conditions have tightened quite a bit. So I would look at that as an important feature. I'd put some weight on it, but I wouldn't say it's something that is the single dominant thing to look at.
If I could follow up, what is your best assessment or the staff's best assessment right now of the current rate of underlying inflation?
I don't have a specific number for you there. So there are many, many models that look at that. And I mean, one way to look at it is that it's a pretty stationary object, and that when inflation runs above that level, for sure, substantially above for some time, you'll see it move up, but the movement will be fairly gradual. So I think that's what the principal models would tend to say. But I wouldn't want to land on any one assessment. There are many different, as you know, many different people who publish an assessment of underlying inflation.
Thank you.
Gina. Hi, Chair Powell. Thank you for taking our questions. Gina Smilek, New York Times. I wonder, do you see any evidence at this stage that inflation is or is at risk of becoming entrenched?
Is inflation becoming entrenched? So I guess I would start by pointing to expectations. So if we saw longer-term expectations moving up, that would be very troubling. And they were moving up a little bit at the middle part of this year, and they've moved now back down. That's one piece of data. Shorter-term inflation expectations moved up between the last meeting and this meeting. And we don't think those are as indicative, but they may be important in the wage-setting process. There's a school of thought that believes that. So that's very concerning. I guess the other thing I would say is that the longer we're now 18 months into this episode of high inflation, and we don't have a clearly identified scientific way of understanding at what point inflation becomes entrenched.
What about printing $5 trillion?
The thing we need to do from a risk management standpoint is to use our tools forcefully but thoughtfully and get inflation under control, get it down to 2%, get it behind us. That's what we really need to do and what we're strongly committed to doing.
Rachel.
Till that money disappears.
Hi, Chair Powell. Thank you for taking our questions.
It's hard.
Rachel Siegel from the Washington Post. The statement points to lag times. I'm wondering if you can walk us through how you judge those lag effects, what that timeline looks like over the coming months or even
There
a
we
year.
go. That's a good question.
And where you would expect it to show up in different parts of the economy.
Yeah, so the way I would think about that is it's a commonly, for a long time, thought that monetary policy works with long and variable lags, and that it works first on financial conditions and then on economic activity, and then perhaps later than that even on inflation. So that's been the thinking for a long time. There was an old literature that made those lags out to be fairly long. There's newer literature that says that they're shorter. And the truth is we don't have a lot of data of inflation of this high in what is now the moderate economy.
They don't know how long
One
it'll
big
take us to
difference
get
now
out of this
is
mess,
that,
guys.
It used to be that you would
They
raise
don't
the federal
know.
funds rate, financial conditions would react, and then that would affect economic activity and inflation. Now, financial conditions react well before, in expectation of monetary policy. That's the way it has moved for a quarter of a century, is in the direction of financial conditions, then monetary policy, because the markets are thinking what is the central bank going to do. And there are plenty of economists that also think that once financial conditions change, that the effects on the economy are actually faster than they would have been before. We don't know that. I guess
This is the biggest experiment, guys.
It's highly uncertain. And so
there you go.
From a risk management standpoint, it would be irresponsible not to ignore them, but you want to consider them, but not take them literally. So I think it's a very difficult place to be, but I would tend to want to be in the middle, looking carefully at what's actually happening with the economy, and trying to make good decisions from a risk management standpoint, remembering, of course, that if we were to over-tighten, we could then use our tools strongly to support the economy, whereas if we don't get inflation under control because we don't tighten enough, now we're in a situation where inflation will become entrenched, and the costs, the employment costs in particular, will be much higher potentially. So from a risk management standpoint, we want to be sure that
they want to put us into recession, kill inflation, then rescue us, rescue the companies.
And
See
if I
that?
could follow up, should
That's
we
weird.
interpret the addition to the statement to mean that more weight is put into those lag effects than they would have been after previous rate hikes?
So I think as we move now into
well, that's
into
right.
restrictive territory, as we make these
dollar
rate hikes and policy becomes more restrictive, it'll be
the position in of the dollar in the world stage, meaning like world reserve currency, will be jeopardized if we don't fight inflation.
But we won't
that's understandable. That is
because it's
good.
appropriate to do so. Let me say this: it's
but they will crash the economy, and then
they think about
after they crash the economy, they will rescue the economy. That's
talking about
I don't know.
Pausing our rate hikes.
This is weird.
We have a ways to go. Our policy, we need ongoing rate hikes to get to that level of sufficiently restrictive, and we don't. Of course, we don't really know exactly where that is. We have a sense, and we'll write down in in the December meeting a new summary of economic projections, which updates that. But I would expect us to continue to update it based on what we're seeing with incoming data.
All right, let's see the ES. So the ES came to this level and is tanking from there. Look at that. They were praising that the market was having a positive reaction.
Some venture-funded tech companies. It's been relatively narrow in terms of the labor market, consumer demand. A lot of sectors don't see a ton of effect. Is the pathway and channels through which monetary policy works changing? Is it narrower than it used to be?
They did cause it. They printed $5 trillion with the pandemic.
That you're crimping housing supply in ways that might cause problems down the road?
I don't know that the channels through which policy works have changed that much. I would say a big channel is the labor market, and the labor market is very strong. Very strong. And households, of course, have strong balance sheets. And so we go into this with a strong labor market and excess demand in the labor market, as you can see through many different things, and also with households who have strong spending power built up. So
for how long?
It may take time. It may take resolve. It may take patience. It's likely to get inflation down. It may. I think you see from our forecasts and others that it will take some time for inflation to come down. It'll take time, we think. So, sorry, was I getting to your question there? Housing, the housing part of it. Yeah. So, we look at housing. Of course, housing is significantly affected by these higher rates, which are really back where they were before the global financial crisis. They're not historically high, but they're much higher than they've been. And you're seeing housing activity decline. You're seeing housing prices growing at a faster rate, and in some parts of the country declining. I would say the housing market was very overheated for the couple of years after the pandemic as demand increased and rates were low. We all know the stories of how overheated the housing market was, prices going up, many bidders, no conditions, that kind of thing. So the housing market needs to get back into a balance between supply and demand. We're well aware of what's going on there. From a financial stability standpoint, we didn't see in this cycle the kinds of poor credit underwriting that we saw before the global financial crisis. Housing credit was very much more carefully managed by the lenders. So it's a very different situation and doesn't appear to present financial stability issues. But no, we do understand that that's really where a very big effect of our policies is.
Victoria.
Hi, Victoria Guida with Politico. I wanted to ask about the labor market. You mentioned early on again that job openings are very high compared to available workers, and I'm just curious to what extent you do and don't draw a signal from that. So, for example, if wage growth is slowing and if maybe the unemployment rate starts to tick up, will that make you sort of decrease your focus on job openings? What do you see? Are wages what's really important? How are you thinking about the labor market as it relates to inflation?
So we talk a lot about vacancies and the vacancy to unemployed rate, but it's just one. It's just another data series. It's been unusually important in this cycle because it's been so out of line. But so has quits, so have wages. So we look at a very wide range of data on the labor market. So I'd start with unemployment, which is typically the single statistic you would look to, is at a 50-year low, 3.5%. We're getting really nothing in labor supply now. We had, I think, a very small increase this year, which we had really thought we would get that back. Most analysts thought we would get some labor supply coming in. You mentioned wages, so I guess I would characterize that as sort of a mixed picture. It's true with average hourly earnings you see. So I would call it a flattening out at a level that's well above the level that would be consistent over time with 2% inflation, assuming a reasonable productivity. There with the ECI reading this week, again a mixed picture. The headline number was a disappointment. Let's just say it was high. It didn't show a decline. There's some rays of light inside that if you look at private sector workers, that did come down. The compensation did come down. But overall, though, the broader picture is of an overheated labor market where demand substantially exceeds supply. Job creation still exceeds, the sort of the level that would hold the market where it is. So that's the picture. Do we see? We keep looking for signs that sort of the beginning of a gradual softening is happening. And maybe that's there, but it's not. It's not obvious to me because wages aren't coming down. They're just moving sideways at an elevated level, both ECI and average hourly earnings. We want to see, we would love to see vacancies coming down, quits coming down. They are coming down. Vacancies are below their all-time high, but not by as much as we thought because, and that, the data series is volatile. We never take any one reading. We always look at, 2 or 3. So it's a mixed picture. I don't see the case for real softening just yet, but we look at, I guess as I just showed you, we look at a very broad range of data.
Wow, the dollar is back
so
up
do you see wages as being a significant driver of inflation?
Where it has started to drop.
I think wages have an effect on inflation, and inflation has an effect on wages. I think that's always been the case. There's always a going back and forth. The question is that really elevated right now? I don't think so. I don't think wages are the principal story of why prices are going up. I don't think that. I also don't think that we see a wage price spiral. But again, it's not something you can, once you see it, you're in trouble. So we don't want to see it. We want wages to go up. We just want them to go up at a level that's sustainable and consistent with 2% inflation. And we do think that given the data that we have,
10-year?
This labor market can soften without having to soften as much as history would indicate through the unemployment channel. It can soften through job openings declining. We think there's room for that, but we won't know that. That'll be discovered empirically.
Thank you so much. Kayla Tausche from CNBC. Earlier last month, the United Nations warned that there could be a global recession if central banks didn't change course. The new UK Prime Minister warned of a profound economic crisis there. And I'm wondering how the Fed is weighing international developments in light of a very strong economy here in the U.S. that would seem to be bucking those trends.
So, of course, we keep close tabs on economic developments and also geopolitical developments that are relevant to the economy abroad.
So where's crude oil?
Very frequent contact with our foreign counterparts, both through the IMF meetings and the regular meetings with central banks that we have, and I have one this weekend with many central bankers. So we're in touch with all of that. So I guess it's clearly a difficult time in the global economy. We're seeing, very high inflation in Europe, significantly because of high energy prices related to the war in Ukraine, and we're seeing China's having issues with the zero COVID policy.
Okay,
and,
cool, Lemby.
Much slower growth than we're used to.
I don't trade this thing. I think it's too much for me.
We see those difficulties.
My levels can be blown in no time, so I'd rather just when he stops talking,
in our models,
I might look for
and that sort of thing.
Some areas.
Here in the United States, we have a strong economy, and we have an economy where inflation is running at 5%, core PCE inflation, which is a really good indicator of what's going on for us, is the way we see it, is running at 5.1% on a 12-month basis, and sort of similar to that on a 3, 6, and 9-month basis. So we know that we need to use our tools to get inflation under control.
So there are a few takeaways of this Q&A.
That's a task we need to do. Price stability in the United States is a good thing for the global economy over a long period of time. Price stability is the kind of thing that pays dividends for our economy for decades, hopefully, even though it may be difficult to get it back. Getting it back is something that provides value to the people we serve for the long run.
If I could just follow up on that. Thank you. Thank you. The Fed has acknowledged in the past that that the tools that you have don't affect things like energy and food prices that stem from some of those conflicts overseas, and they're some of the biggest pain points for consumers. So as you pursue the current path that you've outlined, is there a risk that some of those prices simply don't come down?
So we don't directly affect, for the most part, food and energy prices, but the demand channel does affect them just at the margin. The thing about the United States is that we also have strong, in many other jurisdictions, the principal problem really is energy. In the United States, we also have a demand issue. We've got an imbalance between demand and supply, which you see in many parts of the economy. So our tools are well suited to work on that problem, and that's what we're doing. You're right, though. We don't, the price of oil is set globally, and it's not something we can affect. I think by the actions that we take, though, we help keep longer-term inflation expectations anchored, and keep the public believing in 2% inflation by the things that we do, even in times when energy is part of the story of why inflation is high.
Janelle.
Hi, Chair Powell. Janelle Marte with Bloomberg. So the Fed is facing 2 more ethics-related incidents with the revision of the financial statements from President Bostic and President Bullard speaking at a closed event. So some senators, like Elizabeth Warren, are saying that this is a sign of greater ethics problems at the Fed. Could you talk about what this does to the public's trust in the bank and what the Fed is doing to prevent this kind of behavior from becoming common?
Sure. So you're right. The public's trust is really the Fed's and any central bank's most important asset. And anytime one of us, one of the policymakers, violates or falls short of those rules, we do risk undermining that trust, and we take that very seriously. We do. So at the beginning of our meeting yesterday, actually, we had a committee discussion of the full committee on the importance of holding ourselves individually and collectively accountable for knowing and following the high standard that's set out in our existing rules with respect to both personal investment activities and external communications. We've taken a number of steps, and I would just say we do understand how important those issues are. I would say that our new investment program that we have is up now and running, and actually it was through that the problems with President Bostic's disclosures were discovered when he filed his new disclosures. That's, we now have a central group here at the Board of Governors that looks into disclosures and follows them and approves people's disclosures, and also all of their trades. Any trade anyone has to make who's covered has to be pre-approved. And there's a lag. It has to be pre-approved 45 days before it happens, so there's no ability to game market. So it's a really good system. It worked here. And I think we all said to each other yesterday morning, we recommitted to each other and to this institution to hold ourselves to the highest standards and avoid these problems.
Do you have an update on the investigations that are pending?
I don't. So, as you know, I referred the matter concerning President Bostic to the Inspector General. And once that happens, I don't discuss it with the Inspector General or with anybody. It's just the Inspector General has the ability to do investigations. We don't really have that, so that's what he's doing.
Michael McKee from Bloomberg Television and Radio. Earlier this year, you touted the 3-month bill yield out to 18 months as the yield curve with 100% explanatory power. And you said, quote, if it's inverted, that means the Fed's going to cut, which means the economy is weak. That curve is only 2 basis points away from inversion now. So I'm wondering why you are so confident that you have not over-tightened, particularly given that rates work with a lag.
Well, so we do monitor the near-term forward spread. You're right, and that's been our preferred measure. We think it, just empirically, it dominates the ones that people tend to look at, which is 2s, 10s, and things like that. So it's not inverted. And also, you have to look at why things, why the rate curve is doing what it's doing. It can be doing that because it expects cuts or because it expects inflation to come down. In this case, if you're in a situation where the markets are pricing in significant declines in inflation, that's going to affect the forward curve. So yes, we monitor it. You're right, that's what I would say.
All of the spreads have been inverted.
You also said several meetings ago that the risk of doing too little outweighed the risk of doing too much. Is what you're trying to tell us today is that risk assessment has changed a little bit?
Well, what's happened is time has passed and we've raised interest rates by 375 basis points. I would not change a word in that statement, though. I think until we get inflation down, you'll be hearing that from me. Again, if we over-tighten, and we don't want to, we want to get this exactly right, but if we over-tighten, then we have the ability with our tools, which are powerful, to, as we showed at the beginning of the pandemic episode, we can support economic activity strongly if that happens, if that's necessary. On the other hand, if you make the mistake in the other direction and you let this drag on, then it's a year or two down the road and you're realizing inflation behaving the way it can, you're realizing that you didn't actually get it, you have to go back in. By then, the risk really is that it has become entrenched in people's thinking, and the record is that the employment costs, the cost to the people that we don't want to hurt, they go up with the passage of time. That's really how I look at it. So that isn't going to change. What has changed, though, you're right, is we're farther along now, and I think as we're farther along, we're now focused on that. What's the level we need to get to rates, and I don't know what we'll do when we get there. By the way, we'll have to see. There's been no decision or discussion around exactly what steps we would take at that point, but the first thing is to find your way there.
Thanks, Chris Rugaber.
Thank you. Chris Rugaber at Associated Press. Just to go back to housing for a minute, you mentioned the impact that rate increases have had on housing. Home sales are down 25% in the past year and so forth. But
I don't think that would break something.
It's
hard to be precise.
Inflation measures. And as we go forward, private real-time data is clearly showing these hits to housing. Are you going to need to put a greater weight on that in order to ascertain things like whether there's over-tightening going on? Or will you still focus as much on the more lagging government indicators?
So this is an interesting subject. So I start by saying, I guess, that the measure that's in the CPI and the PCE, it captures rents for all tenants, not just new leases. And that makes sense, actually, because for that reason, that conceptually, that's sort of the right target for monetary policy. And the same thing is true for owner's equivalent rent, which comes off of it's a reweighting of tenant rents.
Yeah, that's
the
not
private
great,
measures are of course good at picking up at the margin the new leases, and they tell you a couple things. One thing is, once you, so I think right now, if you look at the pattern of that series of the new leases, it's very pro-cyclical. So rents went up much more than the CPI and PCE rents did, and now they're coming down faster. So the implication is that there are still, as non-new leases roll over and become and expire, right? There's still in the pipeline, there's still some significant rate increases coming, okay? But at some point, once you get through that, the new leases are going to tell you that what they're telling you is there will come a point at which rent inflation will start to come down. But that point
that could take us years
well out from where we are now. So we're well aware of that, of course, and we look at it. And but I would say that in terms of what the right way to think about inflation really is to look at the measure that we do look at, but considering that we also know that at some point you'll see rents coming down.
Great. And just a quick follow. It looks like stock and bond markets are reacting positively to your announcement so far. Is that something you wanted to see? Is that a problem, or how that might affect your future policy to see this positive reaction?
We're not targeting any one or two particular things. Our message should be, what I'm trying to do is make sure that our message is clear, which is that we think we have a ways to go. We have some ground to cover with interest rates before we get to that level of interest rates that we think is sufficiently restrictive. And putting that in the statement and identifying that as a goal is an important step. And that's meant to put that question really as the important one now going forward. I've also said that we think that the level of rates that we estimated in September, the incoming data suggests that that's actually going to be higher, and that's been the pattern. I mean, I would have little confidence that the forecast, if we made a forecast today, if we were doing an SEP today, the pattern has been that one after another, they go up, and that'll end when it ends.
Wow.
But there's no sense that inflation is coming down. It just, if you look at I have a table of the last 12 months of 12-month readings, and there's really no pattern there. We're exactly where we were a year ago. So
that's not great.
So I would also say it's premature to discuss pausing, and it's not something that we're thinking about. That's really not a conversation to be had now. We have a ways to go. And the last thing I'll say is that I would want people to understand our commitment to getting this done, and to not making the mistake of not doing enough, or the mistake of withdrawing our strong policy and doing that too soon. So I control those messages, and that's my job.
Edward.
Edward Lawrence with Fox Business. Thank you, Fed Chairman. So, how big of a headwind is all the fiscal spending to what the Federal Reserve is trying to do to get inflation back to the 2% target?
In theory, it was a headwind this year, but I do think the broader context is that you have households that have these significant amounts of savings and can keep spending. So I think those two things do tend to sort of counterbalance each other out. It appears consumer spending is still positive. It's at pretty modest growth levels. It's not shrinking, people are, the banks that deal with retail customers and many retailers will tell you that the consumers are still buying, and they're still they're fine. So I don't know how big the fiscal headwinds are, and they haven't shown up in the way that we thought they would in restraining spending. So it must have to do with the savings that people have.
What about the spending? There's tens of billions yet to be spent. I mean, from the Inflation Reduction Act, the American Rescue Plan, CHIPS Act, bipartisan infrastructure bill. How does that play into your thinking about the future?
It's demand is going to have some support from those savings, and also from the strong demand that's still in the labor market. We still see pretty significant demand and a tightening labor market in some respects, although I think overall I would say it's not really tightening or loosening. So we see those things, and what those things tell us is that our job is going to require some resolve and some patience over time. We're going to have to stick with this. That's just we take all that as a given, but we know what our objective is, and we know what our tools can do, and that's how we think about it.
Thanks. We'll go to Nancy for the last question.
Hi, Chair Powell. Nancy Marshall-Genzer from Marketplace. I'm wondering, has the window for a soft landing narrowed? Do you still think it's possible?
Has it narrowed? Yes. Is it still possible? Yes. I think we've always said it was going to be difficult, but I think to the extent rates have to go higher and stay higher for longer, it becomes harder to see the path. It's narrowed. I would say the path is narrowed over the course of the last year, really. Hard to say. Hard to say. You know, again, I would say that the sort of array of data in the labor market is highly unusual, and to many economists, there is a path to. Ordinarily, there's a relationship to GDP going down and vacancies declining, translating into unemployment, or there's Okun's law. So all those things are relationships that are in the data, and they're very real. Data's a little bit different this time, though, because you have this tremendously high level of vacancies, and we think on a very steep part of the beverage curve. All I would say is that the job losses may turn out to be less than would be indicated by those traditional measures because job openings are so elevated and because the labor market is so strong. Again, that's going to be something we discover empirically. I think no one knows whether there's going to be a recession or not, and if so, how bad that recession would be. And our job is to restore price stability so that we can have a strong labor market that benefits all over time, and that's what we're going to do.
But just real quickly, why do you feel like the window has narrowed?
Because we haven't seen inflation coming down. The implication of inflation not coming down, and what we would expect by now to have seen is that as the supply side problems had resolved themselves, we would have expected goods inflation to come down by now, long since by now, and it really hasn't. Although it has come down, but it's not to the extent we had hoped. At the same time, now you see services inflation, core services inflation moving up, and I just think that the inflation picture has become more and more challenging over the course of this year, without question. That means that we have to have policy be more restrictive, and that narrows the path to a soft landing, I would say. Thanks very much.
Fed Chair Jay Powell just wrapping up his news conference after the Federal Reserve lifts interest rates again 75 basis points. The fourth time in a row we have seen this jumbo-sized interest rate hike. A signal in there.
Oh shit, sorry about that. So I was speaking to myself. Thank you, Stuck. How are you feeling, buddy? How are you feeling? So look at the dollar. So the dollar came down big time with the report, with the decision, and look what it did on the press conference. Oh my God. Nice. Nice fishing. I love fishing. It's a good practice for patience. There's nothing better than fishing to develop your patience. All right, so this is my 500 volume bar. All right, so What do we have here? What time was this? 2:53. 2:53, and here is 2:53. So this is the low on the tick chart. Nice. So ADQD is for sure looking down. Markets are dropping 2%. Yeah, the dollar is in the supply from the morning. How much can I trust this dollar? It's very strong. I don't think it has reached any like important level for me to short. Sorry, for me to long here. It's a completely different scenario from the morning. Thank you, King Arthur. See you tomorrow. Yeah. Try to translate. Try to do the same when you're trading. Try to apply the same techniques that you use in fishing. That was one thing that I learned with my therapist. Like, he was asking, all right, are you a disciplined person in any other aspect of your life? Like, yes, I do. I like to keep a very healthy diet. I like to have a morning routine, and I am a very disciplined person. All right, try to translate that same discipline to your trading. All right, so a few takeaways from the Fed meeting. At some point, they will reduce the pace of increasing of the rate increase. At some point. So the time is approaching. Not right now. Certainly not the next meeting. So next meeting is probably 50 basis point. They will keep restricting monetary policy. The question is for how long. And actually, one journalist asked him for how long is the lag that monetary policy usually takes effect into the economy to have some effect into the economy, and he couldn't answer that question. So they don't know. They don't know how long they need to be in a restricted mode, right? And the labor market is tight, and until it softens, and we have a series of inflation numbers softening as well, they will keep this restricted monetary policy. So summarizing, that's what we can get off of the press conference. At the beginning, the market was taking that as a positive sign because media, CNBC and other channels were talking about probably a reduce on the pace of rate hikes. But he came out saying that no, I'm a hawk and I am going to continue this restricted policy for as long as the economy needs it. Okay? So I think 320, I don't really have a good area to trade from, other than I do have some, but they're up here. So at this time, if I lose a trade, it's just the end of the afternoon. I don't feel very confident to take trades right now. And tomorrow is another day. After this big drop, if we have some retracement to the upside, then we'll take the short tomorrow. Let's see what happens, okay? Thank you for being here, guys. If you haven't, please subscribe to the channel. If you like what I do here, hit that like button and activate your notifications so you can be aware every time I go live. Okay? Later. Have a good night and see you all guys tomorrow, 9 in the morning, 9:10. Bye-bye.